You sold your rental property or cottage to fund your retirement. It feels like a win until you file the taxes. That one-time sale can trigger a recovery tax that wipes out your OAS pension for an entire year. I'm Toyin, a CPA and financial planner here in Canada. I'm glad you're here. Today, I'm walking you through the capital gains trap, and more importantly, the specific CRA form you need to file immediately to stop the government from cutting off your checks. Before we get into the capital gains itself, we need to cover the basics of the system. I'm talking about the Old Age Security Pension, or OAS. Unlike the Canada Pension Plan, which you contribute to from your paycheck, OAS is a benefit funded by general tax revenues. Most Canadians who have lived here for a certain period can receive it starting at age 65. It's a foundational piece of many retirement plans. But here's the critical part. OAS is income tested. The government looks at your annual net income to determine how much you get. If your income is too high, they start to take it back. This is officially called the OAS recovery tax, but most people know it as the OAS Clawback. Here's how it works. For the upcoming July 2026 to June 2027 payment period, the government looks at your net income from your 2025 tax return. If your 2025 income is above a specific threshold, the clawback begins. That minimum income threshold for the 2025 income year is $93,454. The formula is simple but painful. For every single dollar you earn above that threshold, you lose 15 cents of your OAS. It's essentially a 15% surtax on that portion of your retirement income. This continues until your income reaches the maximum threshold, at which point your entire OAS pension for the year is reduced to zero. For the 2025 income year, the full clawback happens if your income hits $151,668 for those aged 65 to 74. Think about that. A government benefit you've counted on can completely disappear just because your income in one single year was too high. And this is what sets the stage for the capital gain issue. This is where the plan to cash in on a rental property can backfire. Let me walk you through an example. Let's call our retiree Mary. She's 66 years old and has a retirement income from CBP and a small workplace pension, totaling $70,000 a year. This is well below the clawback threshold, so she's collecting a full OAS pension. This year, Mary decides it's time to sell the rental townhouse she's owned for 20 years. She bought it for $200,000 and sells it for $600,000. That's a $400,000 capital gain. Now, in Canada, only 50% of capital gain is considered taxable income. So of that $400,000 gain, $200,000 is added to our income for the year of the sale. Let's do the math. Mary's base income is $70,000. Taxable capital gain, $200,000. Her new net income for the year is $270,000. Remember those thresholds we just talked about? The clawback starts at $93,454. And OAS is completely gone once your income hits about $151,668. Mary's income of $270,000 is well over that upper limit. So, when Mary files her taxes, the CRA sees that massive income spike. They notify Service Canada, and the clawback is automatically triggered for the following benefit period, which runs from July to June. The result? For 12 straight months, the July of next year to the June of the year after, Mary's OAS pension is completely wiped out. That's thousands of dollars she was counting on for her living expenses gone. This isn't a mistake or a glitch. It's exactly how the rules are designed to work. and it catches thousands of retirees by surprise every year. If this scenario is hitting a little too close to home and you're starting to worry about your situation, remember that the key is proactive planning. This is complex territory, and the best move is often to sit down with a professional who understands these rules. If you want to see how these strategies could apply to your specific numbers, consider booking a consultation. There's a link in the channel description to set up a time to chat. Getting ahead of this is the single best way to protect your retirement. So, what can you actually do about this? The good news is that you have options. It's not about avoiding the capital gain, but about managing the income spike it creates. Let me walk you through 4 powerful strategies. Strategy number 1, time the sale. This is the simplest strategy. If you plan to sell a significant asset, such as a rental property, try to do so before you start collecting OAS at age 65. By realizing the capital gain in a year when you are not yet receiving OAS, the income spike doesn't matter for clawback purposes. Alternatively, if you're already retired, try to time the sale for a year when your other income is unusually low, such as the year you transition from part-time employment to full retirement. Strategy number 2, strategic RRSP contributions. This is a powerful countermeasure. If you have available contribution room in your RRSP, you can make a large contribution in the same year you sell the property. Why? RRSP contributions are deducted directly from your net income. Let's go back to Mary. She had an income of $270,000. If she had $80,000 of RRSP room, she could make an $80,000 contribution. This would reduce her net income from $270,000 down to $190,000. While our OAS will still be fully clawed back in this case, you can see how a significant RRSP contribution could be enough to bring you below the full clawback threshold in less extreme scenarios. Strategy number 3, income splitting. This is a crucial strategy for couples. If the rental property was owned jointly with your spouse, the capital gain is automatically split between you. Instead of one person having a $200,000 taxable gain, 2 people each have a $100,000 gain. This alone can make a massive difference. Furthermore, if you have eligible pension income, you can split up to 50% of it with your spouse to lower your individual net income even further. Strategy number 4, the official Form T1213 OAS. This is the single most important tool to know about if you've been hit by a one-time income spike. Remember how the clawback is based on last year's income. Form T1213 OAS, request to reduce old age security recovery tax at source, is your way of telling the government that last year's income was a one-off event and your income this year will be much lower. By filling out this form, you can demonstrate that the income spike is not recurring. The CRA can then approve your request and authorize Service Canada to reduce or even eliminate the monthly clawback based on your estimated current year's income. This directly addresses the cash flow trap. You should file it as soon as you file the tax return showing the large gain, as it can take some time to process. The last resort, the appeal process. What if you miss all this and you get a letter saying your OAS is being clawed back? There is an appeal process, but it's very limited. You cannot appeal the clawback just because you think it's unfair. The calculation is legislated. However, if you believe there has been a factual error, for example, if Service Canada used the wrong income information, you have the right to request a reconsideration of the decision. This must be done in writing within 90 days of receiving your decision letter. If that fails, you can appeal to the Social Security Tribunal. But again, this is for correcting errors, not for changing the outcome when the income figures are correct. A good defense is the best approach. The capital gains clawback is real, and it can feel like a penalty for a successful investment. Selling a property for a significant profit should be a moment to celebrate in retirement, not the trigger for a financial problem. The key takeaway is this: it's not the capital gain that affects your pension, it's the lack of planning around it. By understanding how the OAS clawback works and using strategies like timing your sale, splitting income, and especially knowing about Form T1213 OAS, you can take control. You can separate that one-time financial income from your stable retirement income. Plan ahead, and you can enjoy both the proceeds from your property and the pension you've earned. If you have a question, drop it in the comments below. I'll see you in the next video.